Hello everyone, in this video I'm going to walk you through the concept of monetary control, how the Federal Reserve changes the money supply or interest rates to meet its objectives regarding maximum sustainable employment and low and steady inflation. Let's start off by what the Fed used to do briefly for a while back in the 1970s. I think this is useful because it's kind of simple to understand and it'll help put other things in context, and that is money supply targeting. So we start off here with the equation of exchange, and that is, of course, the famous MV equals PY. Now, if you had me for macro, or if you've seen my old truck in the parking lot, you know that I take this very seriously. It's on my custom license plate. And this is a very useful way to think about the macroeconomy and specifically the role of money in the macroeconomy. So we've got money times velocity equals the price level times real output. So let's write that down here, and then we can use it to think through how the Fed is going to use monetary targeting or money supply targeting to manage macro outcomes, economic outcomes. And the Fed, is concerned about maintaining full employment, so they want to have maximum sustainable output growth, which will presumably achieve full employment, and of course then low and stable inflation and stable interest rates. So we want to keep the P side nice and stable. We don't want to have excessive price level growth. That would be inflation. We want to keep the Y as growing as high as possible. How does money relate to that? Well, the classic concept is that V is pretty stable. The velocity of money, the rate at which money is spent, is pretty stable. And so any fluctuations in P and Y are going to be directly related to fluctuations in M rather than V. So if the Fed can increase money on a steady path, it can increase the total or the product of P and Y on a steady path. Y, real output, if it's determined by real factors in the economy, or you might refer to those as supply side factors or structural factors, it's going to be growing at some constant rate. And a better way to break down the equation might be to think about the rates of change. So we'd think about the delta M, the percent change. I'll write it down like this: percent delta M plus percent delta V equals percent delta P, which of course is the inflation rate, plus percent delta Y. And let me just label each of these in words so we're all clear what we're talking about here. So that growth rate we'll view as locked in at something like, well, in the post-World War II period, we're at something north of 3%. Let's just use 3% to make the math easy. Okay, and then velocity we said is stable. So that would be 0 because velocity is not changing, so it's got a 0% change. Well, if the world is that simple, then the money supply growth can just be targeted to indicate the inflation rate, right? Because whatever money growth is, it's just going to be reflected, the difference in inflation and real growth. So for example, if we set money growth to 5%, 5 plus 0, we've got a total spending growth over here of 5%. We're going to have a 5% total growth over here, so inflation would have to be what? Well, 2, because 3 of that 5% is taken up with real growth. Okay, and this is the idea of just a simple money growth rule. We get money growth chugging along at some constant. We've got nice, pretty stable constants for real growth and velocity, and therefore inflation will just be the residue or the residual of the difference between money growth and real growth. Right? And then you can target different levels of inflation. If you want a little bit more inflation, you dial money growth up. So let's say we add 1 percentage point to money growth, and now what are we going to have? Inflation at 3 and real growth at 3. If we want inflation to be lower, we'd knock this down like this, and then this would fall like this, and so on. All right, now this is very simplistic, of course. There's several problems with this. One is that observed velocity is not stable. Let's take a look. Velocity of the M1 money stock. M1, of course, consists of cash held by the public and money in demand deposits like checking accounts, and the growth of velocity was pretty stable starting in the late 1950s all the way up through about the early 80s, but then it started fluctuating. It went down for a while, up, down, and you can see it starts to look like a roller coaster here in the 80s and 90s, and velocity's kind of been all over the place, as high as 10 back here before the Great Recession. Now we bottomed out back down at 5. So velocity is not stable. We have ups and downs in velocity. That's going to make it much harder for the Fed to kind of keep up with velocity, because as velocity is changing, they'd have to change M to offset those changes. Well, if they can't anticipate the velocity changes in real time and keep up with them, then money changes could amplify velocity changes, and we could wind up with way too much inflation. Right. Another thing is that money growth affects the real economy and prices with long and variable lags. So the Fed can change money growth today. That might not show up in higher inflation for a year, 2 years, and we don't know. And those lags always are subject to change. Dealing with a very delayed effect. A good metaphor that's been used to describe this is the Fed is kind of acting like an idiot in the shower. There's a lag, right, between the water heater and the shower head. You keep cranking the hot dial up because you want it to get hotter and it's not getting hotter yet. Well, all of a sudden you're on maximum hot, and when the water from the tank hits your shower head, you're scalding. So now you dial up the cold and dial down the hot, but there's still a lag there where that water has to flow and then mix and stabilize. So you're twisting the dials all the time, not accounting for the delays. You're going to amplify the ups and downs of the outcome variables, inflation and output. One reason people like Friedman, the classic monetarist, had recommended just dial in, lock down a money growth rate of 3 or 4 or 5%, and then just leave it alone, because you can't anticipate the lags. However, a problem with this is that if you have real shocks, so if you have changes in output based on positive or negative changes in structural or supply conditions in the economy. So, for example, you have like an oil crisis in the Middle East, and you have a sudden drop in potential output because major resources become more scarce. So let's say you go from where we were, we had okay, so now we have a major oil shock, for example, output falls to 0. If we keep money growth at 5, what are we going to see? We're going to see a major uptick in inflation. And if the Fed is targeting something like 2% inflation, well, that's not going to work. Now, that raises the question of what should the Fed's inflation target be? Maybe it shouldn't be 2%. Maybe it should allow inflation to rise to signal to the public that, hey, we're in a kind of a stringency, we're in a supply shock situation. But be that as it may, if the Fed is targeting 2% inflation, well, 5% money growth would be excessive in this scenario where the real shock took our growth rate down. Right. Likewise, if we had a positive shock to growth, if the Fed is targeting if the Fed has a 5% growth target that's locked in, and again, we'll go with the velocity assumption, which is unrealistic. All right, 2% inflation, 3% growth. Well, let's say we get a positive supply shock, like new technologies coming online that increases real growth to 5% money growth plus no velocity growth, matched to 5% real growth, well, inflation falls to 0. Fed maybe doesn't like that because it's too close to deflation, which is evil, which I'll talk about later. And therefore, what the Fed will say is, well, we want to keep a 2% inflation target. What are we going to have to do? We're going to have to increase money growth to 7. Now, let me just comment on this, that this is possibly what we might call good deflation or disinflation. If inflation rates drop, that's technically disinflation. If this goes negative, right? If this was even higher, if that was 6%, this would fall to -1%. That's not a problem. That's not necessarily problematic, although deflation will always have an impact on debtors and on real interest rates. But good deflation based on productivity gains is not necessarily a problem. That's something we want to keep in mind. Yeah, the Friedman rule there recommended 3% or just some fixed level 3, 4, 5% money growth. It's a beautiful ideal, but it doesn't work in practice. Okay, there's recognition lags of are we in recession or not? Are we in a negative or positive supply shock? Now, we want to also recall here that in the long run, money is neutral, meaning ultimately changes in money are going to be eaten up by changes in inflation. So any change in money that's meant to spur economic growth is only going to have a transitory, temporary effect. So upward increases in money can increase output growth in the short run, but they'll ultimately be reflected in higher inflation. And here's how we want to think about that. So let's reset the inflation. And let's say we're running, let's just go back to my initial 5 plus 0 equals 2 plus 3. Well, can the Fed increase money growth, let's say to 8%? And let's just keep velocity set for now to keep it simple. And in the short run, what happens? Well, inflation happens with lags as well. So maybe inflation in the short run only picks up to 4%, which means what? Well, that total of 8% spending growth we have to have 8% growth in spending over here, so we'd get 4% real growth. So you get a temporary bump here in real growth, but ultimately inflation will eat up all of this change. So in the short run, this is what you're going to be looking at, but in the long run, you're going to be looking at this. 8 plus 0 equals, best case scenario, 5 plus 3. So you revert to your original growth rate. If this increase in the money supply stimulates the economy and causes an overexpansion, what you might end up with is this. 8 plus 0 equals 8 plus 0, or worse yet, you go into recession, 10 minus 2. So you get into a recession combined with inflation, high inflation, like the U.S. economy experienced throughout the 1970s. We had a couple of distinct episodes of inflationary recessions, which wasn't supposed to be possible under kind of a simplistic Keynesian view of things. All right, so in the long run, money is neutral. Inflation, or let me say, delta M is going to show up strictly in the inflation rate in the long run. You can't permanently stimulate the economy. So there's a little basic monetarism. If you took macro with me, this will be a review. Now, let's move on to what the Fed actually does. The problems of money supply targeting that I've just mentioned make it really untenable. And when the Fed tried to do money supply targeting, it was really slippery and it didn't work well. So the Fed switched over and basically for the past almost 40 years has been using interest rate targeting. With interest rate targeting, the Fed can target P and Y while allowing M and V to fluctuate. M and V can just be, can adjust on their own to whatever level they need to be, and then the Fed doesn't have to be so concerned with the lags and with the volatility of those variables. Another reason for interest rate targeting is that it's a better signal, and what I mean by this is it's a better sign to the public and to businesses of where the Fed wants to go. When the Fed reduces interest rates, people understand, okay, now I can afford to borrow more. Homeowners, consumers can afford higher home payments. They afford to purchase a larger home. They can afford to borrow more money to buy cars, student loans, etc. Businesses realize that credit's cheaper, so if they want to do some bank borrowing to expand, it's now more affordable for them. So this is a much better way to signal what the Fed wants to do. There's a warning here. Never reason from a price change. Just because interest rates are going down, that doesn't mean the Fed is expansionary. That doesn't necessarily mean that credit's getting more affordable. Just because interest rates are going up doesn't necessarily mean that the Fed is ultimately tightening things and making credit less affordable. The reason why it's as complicated, but we have to filter interest rate changes through the Fisher equation and understand not just their short run impact, but their longer run impact. All right, so I want to ask us this question. Do lower interest rates mean loose or expansionary monetary policy? Not necessarily, right? We want to do a supply and demand analysis to figure out why interest rates are changing, and then we want to run those changes through the Fisher equation to understand what the long run outcome is going to be. So let's do the supply and demand analysis. Interest rate, I, is the price. Quantity of loanable funds, that's the quantity that's changing. We have a supply of loanable funds, which is individual savings. Of course, that can also be adjusted by the Fed, which we'll get to here in a few minutes. And a demand for loanable funds, which is the public's and business credit demand. So this is based on the desire, the willingness for people and businesses to borrow. And then there's some equilibrium set of interest rates that equilibrates these quantities and some equilibrium quantity. Okay, now we want to think about two reasons for a interest rate declining. Of course, we could just flip this all around for higher interest rates. So let's call this I1. And interest rate can go down to I2. Okay, never reason from a price change because we don't know what factor is causing the price to change. Is it supply shifting to the right? Supply 2. Okay, in which case there's a higher quantity of funds available for business and the public to borrow, in which case it's possibly, likely a good thing that there's more borrowing happening because there's more supply of funds. People are more willing to save. That enables other people to borrow and expand investment and consumption, what have you. So that's maybe, that might be a good reason for interest rates falling. Right? The other reason, of course, is that we have a demand shift. So let's do it this one, shift the demand curve right here. And that takes us down to this lower level of interest rates as well. And what's going on there? Well, the public and business is less willing to borrow. Why would people be less willing to borrow, to buy houses, to buy cars, to take out student loans? Well, it's probably because they have higher anxiety about borrowing, uncertainty about their future income. Same thing with businesses. If businesses slow down on their borrowing, it means they don't feel like they have really good prospects for investment projects paying off. So this is maybe a bad reason. So if we go to this, let's call the other one equilibrium S based on savings, and we'll call this one equilibrium D based on demand, based on supply rather over here. We'll call this E sub D based on demand. This is maybe a bad reason for interest rate decline. So we want to understand what's happening here. If interest rates are going down, it might be the result of factors that are causing economic expansion, supply shocks. It might be the result of factors that are causing economic contraction, negative demand shocks. So we've got to understand the underlying forces in the economy to interpret the price changes. And that's what we mean by never reason from a price change. You can't take the price change and presume what's happening. You have to know the underlying factors that are leading to the price change to really understand. So that's one reason that makes it difficult to interpret interest rate changes on their own. Another factor, of course, is the Fisher equation, and I hope this is also familiar to you if you took macro. Hopefully you learned this. I don't know if everybody covers it, but this is the idea that nominal interest rates, so the interest rates we see, have two components. There's an underlying real interest rate, which is based on the kind of fundamental components of interest. If you take finance classes with me, you'll learn that interest is made of two pieces. One is the time preference component, which is basically how willing people are to save or how patient people are. And that's also known as originary interest. And then there's a risk component. So, of course, higher risk investments and loans carry higher interest rates to compensate for that higher risk of default. So there's a time preference component and a risk premium component. That's the underlying real rate. Now, of course, we have to add expected inflation to that underlying real rate to offset the fact that inflation reduces the value of money and the lender or investor is getting repaid in cheaper money, and of course has to offset that. So sometimes you'll see the equation written down like this: I for nominal rate equals R for real rate plus pi sub E expected inflation. So you might see that nomenclature used in here. And we could think of examples. So let's say mortgage rates are currently 5%, underlying interest rates are maybe 3%, expected inflation is therefore 2%, right? And what will happen to the real rate if inflation goes up? Let's flip the equation around. So the real rate, if I isolate that equals in nominal rate minus expected inflation. So if that nominal mortgage rate is 5%, 2% inflation, leaves us with a real rate of 3. Now, you have a locked-in mortgage rate of 5%. Now inflation rises to 5%. What does that do to the investor's real rate of return? It wipes it out, right? So higher inflation means going forward, investors are going to have to compensate themselves for that inflation wiping out their real return. On new loans, what's going to happen if inflation is 5%? Well, actually, let's go back to this version of the Fisher equation. On new loans, if the expected inflation is 5% and they want to maintain that 3% real return, what are they going to have to do to the nominal rate? They're going to have to adjust it upwards, right? So nominal rates get adjusted upwards when inflation increases. And of course, if inflation decreases, nominal rates can get adjusted downwards, right? What if inflation falls to 1%? R equals I minus pi E. Let's say the mortgage rate is 5%. Inflation has fallen to 1%. Real rates have risen to 4%. Well, If the underlying real rate is really 3%, there's going to be arbitrage by different financial institutions to pull that back down. And the way that will happen is they'll start offering a 4% nominal rate minus the new 1% inflation to bring that real rate back down to what it is. And again, remember, that's determined by these factors up here. These are kind of underlying factors in the economy. And then we just have to overlay those underlying factors with this inflation factor, which is due to monetary policy. Okay, so declining, here's the lesson. Declining inflation, well, let me do this one first. Rising inflation, so if inflation rates rise, if inflation goes up, we're going to have higher nominal interest rates. And if inflation goes down, we have disinflation or deflation for that matter. Inflation goes down, that is eventually going to lead to lower nominal interest rates. Okay, well, what does this mean for monetary policy? If you see higher nominal interest rates, well, that could be the result of inflation rising. And what caused the inflation to rise to begin with? Well, it could have been an increase in money, right? So we could have an excessive increase in money leading to inflation, which is ultimately going to lead to higher nominal interest rates, even though the purpose of this increased money growth was to reduce interest rates and stimulate the economy. Likewise, if you see in lower nominal interest rates, is that the result of monetary stimulus? Well, maybe in the short run, but in the long run, that could be the result of monetary contraction, MV equals PY, where the Fed says, we need to reduce the rate of money growth. So we had money growth high, and we said, no, we need to make money growth much smaller, so it has less of an impact. And so inflation went from being high to lower, and therefore nominal interest rates can fall due to the inflation premium being reduced. So lower nominal rates, is that the result of monetary stimulus? Well, again, maybe in the short run, but in the long run, that could be the result of monetary contraction. And let's look at some historical data to get a handle on that. Okay, so I'm going into Fred and looking at the federal funds rate, which of course we know is the monetary policy rate, that's here in blue. And then the inflation rate as determined by the consumer changes in the consumer price index, all items. And notice that the federal funds rate in blue will move pretty well with the inflation rate, although there are times when inflation will get ahead of the Fed funds rate. So for example, here in 74, inflation is peaking at an annual rate of 12%, and the Fed funds rate only gets to 8.5%. So there you have actually negative real interest rates because inflation's higher than your nominal rate. And that, of course, is associated with a recession. You see we're on a gray recession bar right there. But that high interest rate does still, previously high interest rate kind of stifles some spending and investment activity, and it pulls the inflation rate back down. Okay, then we have another boom period in the economy here in the late 70s. Inflation is rising, and inflation peaks here at 14% in 1980. And that's a crushingly high level of inflation. And in order to get that inflation under control, look what the Fed has to do with the federal funds rates. Bring them up to 17% here in 80. They did come back down for a while, down back to 9%, but then they bring them up and hold them for almost a year at longer than a year at very high double-digit rates. Okay, so this right here is contractionary monetary policy in the short run, and you can see that there's a double-dip recession here. The Fed is putting us through a two-phase recession with double-digit interest rates, but ultimately that's setting the stage for the inflation rate to come tumbling down. Inflation rate's going to fall all the way down to less than 3% within a couple years, and that's seen as a major victory over inflation, right? If you want to know how to beat inflation, look at Paul Volcker and how he did it here in the early 80s. And that will allow that nominal interest rate to decline as well. You see the Fisher effect back at work, right? And the gap between the blue and the red line, what is that? Well, that's the real interest rate. So you see in this period of disinflation, the real interest rate is rising. And what's going on there to cause the real interest rate to rise? Well, it's probably driven by increases in credit demand for businesses and consumers who are ready to expand, right? Ready to spend more, invest more, and purchase more during this nice economic boom period here in the 80s, right? We saw a similar kind of economic boom in the 90s. You can see the inflation rate's nice and low, the nominal rate's above it, so real rates are positive. Here in the later 2000s, we saw the reverse. We saw negative real interest rates for a while. We saw the Fed have to tighten policy here to control inflation and the asset bubble, of course, which helped to trigger a major crash in the economy, especially in the housing sector. We see inflation go above nominal rates again. We have negative real rates, which is usually a problem. The Fed has to. We get into deflation here after the contraction in the economic crash in '09. We see actual deflation here for a while, which I've told you was like poison for central bankers. They never want to let that occur. They get us back to some positive inflation with very low interest rates, right? So, and then here we're finally back to a situation where the nominal interest rate is above inflation. Well, at least it was there for a while. We're now back down to a loosening cycle with interest rates coming down. So, right, what's going on here? What does this history say? It's not just a simple relationship that the Fed cuts rates and that causes the economy to grow faster. That's the initial aspect, right? The Fed cuts rates, we get into growth, but that picks up inflation. Then the Fed has to raise rates to kill off the inflation. So you want to keep in mind two things when we're talking about the relationship between interest rates and economic growth. If monetary policy is too loose for too long, it's going to cause too much inflation, and per the Fisher effect, that's going to lead to higher nominal interest rates. And then vice versa, if monetary policy is too tight for too long, that's going to squeeze out inflation and lead to lower nominal interest rates. Right? So keep kind of the basic thing in mind where yes, in the short run, and we'll talk about this in the next video, through the channels of monetary policy, the Fed can reduce interest rates and spur lending and spending and investment, but too much of that causes inflation, causes interest rates to rise again, right? So the Fed doesn't have total control of the economy in the long run. The Fed is trying to dial things in to keep them in line with an economic reality in the short run in a best case scenario. The Fed makes mistakes, overdoes it. The Fed sometimes causes needless recessions, or the Fed causes excess inflation like it did in the 1970s with policy that was arguably way too loose for too long. And then the Fed had to engage us in this double dip recession in the early 80s by pushing interest rates through the roof to control this rampant raging inflation.